gone through your business models and so on. And then next you have the implementation of system changes. So that's quite a bit further ahead. You've started thinking about what kind of documentation, et cetera, that you're going to need. And then your next point of next possibility is that you're just about done. This could be where, you know, you're trying it out. You're taking a look at how to, say, for example, 16 and 17 look if you're doing the full retrospective, or you're simply doing the calculations for 16 and 17 if you're doing one of the two modified retrospective methods. And then the final one, of course. So, okay. So here we are, pretty good. 14 and 52% in the assessment, 21% implementing, and then completed 2. Well, I guess you do have a few more weeks left. And no action needed. And interesting. Okay.
All right. Thank you so much, Tony. Just to start off our discussion, I'm going to start with Alex. What are you seeing in the public sectors? Where do companies stand in their implementations?
Thank you, Christian. As a matter of fact, the results of this polling question are not too surprising to me. This is pretty much similar to what we have seen. Most of our clients in the assessment phase are right now, and those clients that are in the assessment phase that we have are primarily those oil and gas companies that do not expect to see any changes in the amounts of the revenue recognition itself, but more so on the presentation and disclosure side, given that the oil and gas industry is not expected to have significant changes. And I'm based here in Houston, Texas, and our clients are primarily oil and gas and engineering and construction focused. So I'm really going to be commenting more so on the industry I'm seeing here. We do have a client who has early adopted the standard, but it's not really a norm for the oil and gas industry. And most clients are still struggling to ensure they're caught up with the timing. And given there has been a downturn in the oil and gas industry for the past couple of years, they have been more procrastinators and not, early adopters. Just to give you an example, we have 2 public clients who just started the assessment phase just mid-November, actually. And one client is the exploration and production company, and another is an engineering and construction company. And both companies really believe that the impact is not going to be material to them and deferred, the assessment phase as much as they could. And unfortunately, for the engineering and construction company, they're finding themselves more behind the curve, because E&P company does not have significant impacts really based on the results of the assessment, as they have point-in-time contracts and have very little changes, if any. But the engineering and construction company is actually now realizing they are running a bit late on the implementation. They do have percentage of completion overtime contracts and variable consideration items such as liquidated damages, which now are going to have to be estimated at the inception as part of the transaction price and recognized throughout the overtime recognition. These engineering and construction companies actually realizing now as well that its backlog disclosures are not sufficient under 606, and they will need to reestablish new processes, controls, and be able to capture data to comply with the new pronouncements. So they're finding themselves behind, given that they're just completing the assessment phase, and now they have some catch up to do on establishing process as they go forward.
Right. So it sounds like they may be at risk of missing the deadline. So Shauna, do you have any advice for public companies that may be at risk of missing the deadline?
Well, Christian, hopefully none of those companies will be in that situation. Being an optimist, I'm hoping that's the case. But if you're a 12/31 public company and you need to comply at that date, at this point, if you're not finished or close to, you should probably go with Plan B. And I think many companies that perhaps wanted to do a full retrospective have realized a modified retrospective is going to be the only way to get done. Now, technically, reporting doesn't have to happen until your first quarter, so your 3/31 reporting date. So that'd be filing in mid-April. But many companies will need to show the impact, at least most of the impact, in your Form 10K. You can't forget about the SAB 74 requirements, and we've seen some of the early adopters do that, where they pretty much presented the full implementation impact in their 10K. But if you're not done and you have a 12/31 deadline, time to bring in reinforcements. And many of the big consultancies, the big four, et cetera, may not be bringing new clients in if you haven't started. If you're partway along, you might be able to get some interim help, or just throw people internally at it. I mean, it's time to focus. One of the reasons I think this project's taken so long for some companies is because the people that are in charge of implementing it have not been able to focus on it. It's kind of a rare situation where you have either a full-time project manager or internal people that don't also have day jobs and are trying to do this in the after hours. But I think the best advice right now is to come up with a detailed project plan, get a project manager to hold everyone accountable, and make sure you're communicating with your auditors and your audit committee. And right now we're looking for the minimum viable compliance. We're looking for a C passing grade. There's no awards for the best revenue recognition implementation. You don't need an A+. You just need to pass at this point. But while you're doing that, make sure you don't forget about the controls and the disclosures, because even if you think you've hit the finish line and are passing, if you don't have those controls in place, there may be a good deal of surprise that is in store. And then I would say for the following year, after you get through this minimum viable compliance, that might be a place to look how to improve, perhaps do some automation at that point. Because remember, in this following year, if you do a modified retrospective, you still need to disclose the impact on every line item in the financial statements during the year of adoption.
Yeah, all right, well, great. That was great advice and some really good tips in there. I mean, but even looking past the upcoming public deadline, you know, private companies they have a little bit more time. So John, what are you seeing in the private sector related to where companies stand in their implementations?
Yes, I'm primarily the clients that I work with and other companies I've been talking to about the new standard. I think most of them are either in the haven't started or in the assessment phase. And a lot of them are still uncertain. You know, the standard can be very complex to understand, as some of the areas are very generally written. So, okay, what's the impact going to be on my company? Is there going to be an actual change in when I can recognize revenue? Or is that going to stay consistent and I'm just going to have to document that? So I think the private companies are starting to look for help, whether it be internally, hey, I need to get a couple of folks lined up to really start taking a deeper dive into this, or I need to get some help from outside our company because we just don't have the bandwidth. I think that a couple of pieces of advice I would give to private companies are, one, don't assume that there won't be any impact, because there certainly have been some cases where you would think, if you just look at a company and the business that they do, that they're a typical traditional manufacturing or distribution company, and so, you know, what impact would this possibly have? And there could be some customer arrangements that they have where there actually is going to have to be a change in when they can recognize that revenue. One good thing about being a private company in this circumstance is that because the public companies are going to have to adopt the standard starting 1/1/18, you're going to have a lot of visibility into seeing if you've got companies in your same industry that are adopting the standard a year before you are. You can look to see how they've dealt with it. Doesn't mean you'll have the exact same answer, but there's certainly going to be a lot more tangible examples out there of what companies are doing and how the standard is impacting them.
Great, thank you. So Tony, it's my understanding that you've actually conducted quite a bit of research on where companies stand in their implementations. Can you talk a little bit about what you found and how it may relate to our results from today's poll?
Sure. Yeah, there's certainly the publicly traded companies have been working on it. The larger ones are certainly further ahead. And, you know, as was just suggested, for private or for smaller companies, what you really should be doing is looking not only, you know, next quarter when companies start announcing, publicly traded companies that have calendar year end start telling you about it. You can, of course, look at the SAB 74 disclosures. You can see what's going on. And as you can see on the screen, this is where companies are, you know, where they haven't started assessment, who's finished the formal assessment, and so on. So what you can do is take a look at the third quarter SAB 74 disclosures and find comparable or similar companies in your industry, et cetera. They'll tell you what's going on. What companies are finding in this implementation, the ones that have been working on it so far, is that, as Shauna had suggested, they do need to think about what their systems are, what how well those systems are set up, so that in order to apply 606, the new documentation needs, the new disclosure needs, the new requirement for many companies, not for all, because SaaS companies have been capitalizing costs. Some of them, they've been doing it differently. The definition was different. The amortization terms were different, but at least they were used to it. But many other companies were not. They weren't capitalizing anything. So these kinds of changes are where you need to be focusing on. Back to you, Kristen.
Okay, great. Thank you for sharing that with us. And next, we're actually going to change topics and move into some of the challenges that companies may be facing in this implementation. And to start off, we're just going to jump right into our second polling question. Julia?
Thank you, Kristen. You should all be able to see the polling question on your screen. Our second poll is your company facing any challenges implementing the new standard within the compliance deadline? And please select one of the following options. No, you're not experiencing challenges and you're on track. Or yes, you are experiencing challenges, whether it's budget, competing priorities, system changes, or still awaiting accounting interpretations. I'll give you just a few more seconds to respond.
Great. Even while we wait for some of these results, Alex, based on your experience, do you think public companies are falling behind, and why do you think that?
Yes, actually, I do think that many public companies are probably falling behind based on my experience. Now, again, I'm basing it on the oil and gas market, which has been depressed, and companies haven't necessarily done, a compliance exercise as part of a priority. They have other bigger fish to fry, and budget is really the area of concern for them. And so those companies that are really falling behind, they're falling behind because they're underestimating really what it takes to comply with the new standard. They have been procrastinating as much as possible and really delaying the start of that assessment phase to see whether they're impacted or not. Because that is a key phase in the whole adoption process, because if the company believes that there's really no impact, if after they dive into the assessment phase and they really see and evaluate what are those impacts they have, that's what's going to really cause them to have either significant expenses as it relates to the implementation, or not so much, because they would be able to do it either in spreadsheets or with their existing accounting departments. But that is the key, was for them to start the assessment phase, which I see a lot of companies have been procrastinating until Q4 to start that. And for companies also believe that the standard is not really going to affect them much or impact them much, and they have really been forgetting about the unknown part that they don't know about their company and their contracts that really need to be looked at really closely. Also, I believe the company tends to focus on the recognition requirements, and I've seen that over and over again in the Fortune 500 and the smaller companies. They really think about, okay, well, how is the standard going to impact me from recognition perspective? And really deferring the disclosure requirements, and that is where you have all of those new 120 plus disclosure requirements and new standard that some companies that have at a point in time transfer of control on all of their performance obligations may not have that many disclosures to deal with. But then on the other hand, those that have over time components, have multiple performance obligations, have different types of variable consideration, are going to have to deal with a lot of disclosures and the roll forwards that they are not used to dealing with before. And quite honestly, many companies will need to develop new mechanisms and processes and may need to obtain different solutions to really allow them to be able to capture that data and track all of those disaggregated data disclosure requirements now.
Yeah, thank you. And it looks like from the poll results that these results mirror a little bit of what you're saying, and we can sort of break this down into, I guess it looks like 3 major categories, you know, competing priorities in the implementation phase, awaiting accounting interpretations from a technical guidance perspective, and even the system changes. You know, so if we break those down, John, can you share with us, you know, what you think might be causing these problems related to the implementation process specifically?
Sure. Yes. I think I'm certainly not surprised by the competing priorities and awaiting interpretations making up. If you add those 2 together, they're the majority of the concerns and issues.
Mm-hmm.
You know, anybody that is in you know, in the accounting department of a company, or the CFO, the controller, the president, if it's a smaller company and they're involved with the high-level accounting, their as somebody else said earlier on the call, you know, their day-to-day tasks and other responsibilities don't go away and create time to adopt this complex new accounting standard. And so trying to find the time to even get started. And then the question is, well, how do we start and where do we start? Because there's this standard, there's a ton of interpretations out there now. You can go search on the internet. So, you know, how do we get moving on this? You know, how do we get from the starting point to really getting into detail? That's where things can really stall out, because you kind of get started and then, okay, well, where do we go? And that's where we've seen companies need to go out and get some help from outside just to get a little bit of bandwidth to get over the hump. And even once companies are getting started, what I've frequently seen is, okay, well, let's look at our different types of revenue. You can call them revenue streams. And then for each one of those types, we're going to go through the new standard's got a 5-step process. And within each step, there's some key pieces. That's where it can get really tricky, because interpreting, okay, well, I think this piece doesn't apply to me, but I'm not 100% sure. That's where the technical side of it can get really challenging. And then also, company may say, okay, well, we need help from our auditors. You know, we're required to get an audit. We're going to need to call our auditors and get their suggestions. And, you know, what I'm seeing in cases where I'm not the auditor on the advisory side, you know, the audit firms have to be careful there, because you can't cross a line of no longer being independent. You can't just do the assessment for a company. So there can certainly be discussions and help provided, but they can't get you all the way there. And then the other piece I'm seeing is for companies that have made a lot of progress, particularly ones where there's going to be a change. If they have a particular type of contract where historically, let's say they've recognized that when they finish the whatever it is, service or good that they're building, they recognize all the revenue at the end. And under the new standard, they should be recognizing that over time as they do the work. Well, it seems like the hard part would be, I just need to know if I'm going to do this modified retrospective. So if I'm a private company, I'm going to figure out, as of January 1st, 2019, what's my cumulative catch-up? What's my impact of the new standard going to be? Then I'll be at the finish line and I'm done and I can celebrate. But then you step back and you go, oh, well, geez, now I have to figure out after that date, I've got all these existing contracts, all this existing revenue. Now I'm going to have to live this day to day. I have to apply the new standard to everything going forward. And it's not the way that I've been doing it in the past. So how do I get my arms around dealing with post-implementation or post-effective date? And that's catching some companies by surprise. Because you're so focused on the initial adoption, but then you realize that after that, it can be very challenging to actually live by the standard day to day.
Yeah.
So those are the main things I'm seeing.
Okay, great. Thank you. And I mean, if we move to the technical piece, Tony, what are you seeing companies finding most challenging related to the specific accounting guidance?
Okay, thanks. Yeah, I think that in terms of on the technical side, for example, probably when you start thinking about, let's say, the recognition as to when revenue has to be recognized, you're going to find that there are some very important changes. For example, if you work with distributors and resellers, then there is the issue of the difference in timing of revenue recognition with respect to where today you're waiting until the distributor tells you how many final sales or sales to the end user they had. Under most circumstances, you'll have to estimate under the new standard. For that estimation, you need a significant amount of evidence, you need documentation, and potentially changes to your systems if you don't already have something fairly robust. But the main question is whether you've got the data that you need. And then how are you going to do the estimates? And the accounting for variable consideration is not, it's different. It's not straightforward. It can be difficult. When you get into measurement, there are many changes that come in addition to the estimation of variable consideration. There are changes with respect to financing. We've never accounted for a receipt of cash from the customer significantly in advance of when we provide goods or services. But now we have to do that. If you go further down the line, there's, of course, with respect to recognition and measurement, there are issues with cost capitalization, both the incremental cost and the fulfillment costs. Some companies do have experience with incremental costs, but very few have any experience with capitalizing fulfillment costs. You may never have tracked those fulfillment costs in the same way that you're going to need 606. But then you come, after you've done the recognition and measurement, you get to the third leg of this whole thing, which is disclosure. And there are significant changes with respect to disclosure. One of the disclosure requirements that most people are having really difficult times with is that of the backlog disclosure. And part of the problem is that some, and I think somebody alluded to this earlier, manufacturing companies do provide backlog disclosure today, as is required by the SEC. But the definition of backlog and the definition actually of firm contracts in the SEC requirements is extremely vague. And you certainly can't compare it. 606, on the other hand, does require something that many people are calling backlog disclosure, which I don't think it is. But in any case, the point is that it only applies to valid existing contracts. You can't apply it for, or you can't come up with it from the firm contract. So in that sense, there's a substantive difference. There's an enormous demand on data. And I think the disclosure requirements, particularly this so-called backlog disclosure, is one of the most difficult challenges. Another speaker had alluded to the issue of full retrospective versus modified retrospective. I think that's where the challenge is for your FP&A team. Because if you do pick the modified retrospective, which there might be good reasons for, the problem with modified retrospective is that it's not going to give you the type of data that you need for comparative purposes, for prediction, for forecasting, and that makes it very difficult. And then Shauna had earlier referred to internal controls. Well, that's a fundamental component of financial reporting. That's another area where you'll have to be very careful, because if you're changing recognition, measurement, and disclosure, then you also have to think about how the controls have to change for that. Back to you.
Sure, thank you. That was definitely one of the bigger challenges that I think companies are facing. And the last one in that poll that we hadn't discussed yet was the systems changes. And that leads us into our next topic, which is systems change and processes. And we'll just jump right in. Shauna, what are some of the reasons companies may be looking at implementing a new solution?
Yeah, I mean, we're seeing clients look at that for a lot of different reasons. You know, like Tony mentioned, there's a lot of additional record keeping and accounting requirements with these new standards, not to mention the controls needed. So real-time documentation and evidence of the estimates and judgments that are being made, which are more significant than in previous standards, is really key from an audit perspective and a good internal control perspective. You know, you have things like the variable consideration that is potentially changing every quarter, and with the benefit of hindsight, could look different if those estimates and judgments aren't documented at the right time. You know, new guidance on contract modifications, I think, would be one of the drivers. And then we're seeing some of the clients that we have implementing an additional system such as SOFTRAX just for the fair value allocation, the standalone selling price allocation, just for this one issue. That's certainly an issue that is really difficult to do through Excel. And I always say, you know, this is kind of, you know, a lot of times the revenue systems may be a bit outdated, and this could be a good time, particularly in the second year, once you experience some of the pain of maybe trying to do a topside adjustment and a modified retrospective calculation, could be a good reason to get approval for a long overdue revenue system upgrade to help make the accounting on an ongoing basis sustainable and controlled.
Great, that's definitely very helpful. So let's go ahead and initiate our third poll and see where our audience stands from a systems perspective. Julia.
Thank you, Kristen. So our third poll is asking which options your organization is planning to utilize in order to comply with the new revenue recognition guidance. We have a few options to choose from: spreadsheets or manual workarounds, custom code, or developing, you know, homegrown solutions, ERP systems, automation software, or none of the above. And there is an option on this poll to select more than one option if it pertains to you.
So while we wait for some of those results to come back, I'm just going to jump right into the first one here. John, what are some of the limitations that companies may run into if they plan to handle revenue recognition systems on spreadsheets or have manual workarounds?
Sure. I think that the biggest challenge with doing that that I've seen would be there. You know, there's a potential to be able to figure things out using spreadsheets and workarounds to get to that kind of implementation effective date. But where the challenge comes in is when you're dealing, you know, when you're dealing with going forward. Similar to what I mentioned related to a previous question, the challenges of living the new standard day to day, and all of the new customers that come up, the new arrangements, particularly if you have kind of different conditions with different customers, and how to kind of follow those through so that you're not scrambling at the end of every year, if you're public at the end of every quarter, having to backtrack and manually shift a lot of things around. So it's really the biggest challenge I've seen is there can definitely be challenges during the implementation, but it's also that after you've reached the effective date, trying to deal with all the volume, particularly if you're going to have an impact on the timing of when you can recognize that revenue. Back to you.
Great, thank you. And it looks like from our polling results, spreadsheets and manual workarounds seems to take the cake there on the most for our audience here. And after that, we have ERP systems and then automated software, none of the above. So some people aren't changing what they're doing, or custom coding. I guess in terms of some of the things that organizations may be doing internally, Alex, if companies are planning to hire additional personnel to meet some of the challenges, are there additional challenges that come with that in itself?
Well, I do think that we are all aware that obviously it's not cheap hiring and training people and maintaining an effective number of bodies per se in an accounting department. More so when you have to create a sustainable process going forward, and people come and leave, and so it's costly. I mean, we all know it's costly, and actually, quite honestly, it's not surprising, as you know, that so many percentage of people say they're going to do it in spreadsheets, but then, you know, spreadsheets have to have enough control environment in it to, you know, mitigate risk of errors and fraud, right? And when you go back to the, you know, personnel, training personnel to ensure they act as a control environment as well and are able to identify the right accounting challenges under 606 does take time, effort, and it's costly. and anytime companies do elect to use more people and spreadsheets and less automation, we all know that the risk of errors and opportunities for fraud increases. So with that comes, a need for adequate controls to be built in to ensure adequate compliance, right? And so there is this cost-benefit type of an analysis that each company is probably doing to determine what's the best way for them to comply on it going forward.
Right. Great. And I know we already talked about this a little bit earlier, Tony, but there are so many new disclosure requirements. Is there any way that companies can really prepare for this new disclosure requirement, either using their current systems or implementing a new system? And are there any specific disclosures that people are currently facing, or having the most difficult with?
Yeah, I think that the additional work required and the data, documentation, et cetera, that's required in these disclosures does put pressure on people, and they should start thinking about, if they haven't already, about system changes and so on, or at least going in for taking a look at some software solution, automated solutions. Because it's very difficult to do this with Excel, great as Excel and all of its wonderful functionality is, but and it's not very good from an audit perspective and from a controls perspective. So from those objectives, you should be thinking about it. But the main ones in disclosures, I would say, are the new estimates and the data required for the new estimate. So the estimates that you need, the new ones, primarily, for example, for variable consideration. But there are quite a few other related issues as well of that type. Then in addition to that, you have these disclosures for the backlog, as I said, in other words, the amount of the deferred revenue and how much you're going to collect, when you're going to collect it. So tracking that and creating the systems that you need, the databases that you need for that disclosure, those kinds of disclosures is very, very important. Even on the cost side, for the amortization, many companies are going to will have to amortize over the customer relationship term. If you're not a SaaS company, then it's unlikely that you've spent a lot of time thinking about the customer relationship term. So tracking renewals, and that I do understand, and I do note from many companies that their customer retention rates are a matter of pride. So many companies do like to report that, but it's not just having that number. You have to use it in a certain way to get to have it contribute to your assessment of the customer relationship. So those are some of the major things that you're going to need in order. Those are the major needs, and those are the ones that would suggest that you start thinking about some kind of an automated solution. Then talk to your FP&A people, and they'll tell you how important it is and why they need it as well. And then what you want to do is come up with a system that allows both of those. I mean, I know of companies where they keep different sets of books, in the sense that there's some data that's needed, some kind of information that's needed for FP&A, which is quite a bit different from what's needed for financial reporting. And then there's a third set. There are companies that like to keep information on a non-GAAP. So some of those computations can be done have to be done somewhat differently. Non-GAAP reconciliations are required, so you automate all of that. Those are some of the things that I would suggest.
Great, thank you. Now, you and Alex both just mentioned, how much it might cost to, hire additional people or implement some new software, which brings us to our next topic, which is costs and risks. And so I think we're going to start off here with the fourth and final poll, which is up on your screen. If Julie, you want to walk us through this.
Thanks, Kristen. So the fourth and final poll is just asking what, or I should say how much you anticipate the project cost for implementing the new Rev Rec guidance. This is just an estimate, and you may be unsure, so you can select that as well at the bottom.
Thank you, Julia. And while we wait for the results, Alex, you mentioned earlier that there were additional costs to hiring personnel. So, you know, that's an internal cost. What about, like, what are you seeing as the costs involved for internal and external costs of implementing the entire project?
You know, quite honestly, I don't think there is a one way to answer this question, because you have to really step back, and I don't think all companies are created equal, right? And so you have to really analyze it on a company by company basis, because there's really not one price tag that will fit all, if you know what I mean. And, you know, as it relates to the implementation of the standard, because costs can really be all over the board, and I have seen both. I have really seen, you know, costs less than 500,000, you know, a lot of those, and I have seen costs as high as 3 million. And so the reality of it is really depends on how complex your organizational structure is. Are you operating on a centralized or decentralized environment, right? Do you have multiple different ERPs and, you know, a lot of different operating units and a global organization, or do you really operate in one state in one country, right? So a lot of those things you have to really think through before you really can understand what your needs be. You know, are you going to need to hire new people? Are you going to need to hire externally, you know, to have somebody help you transition? Are you going to need to implement new systems to be able to track that information going forward? So I really don't think there is a one-way answer to all, you know, and the question is, you know, how much automation do you want to create in your company to comply with it on a going forward basis, or do you really are willing to hire more people rather than automation? That's all those different decision points, and really it's really boils down to what the company is really looking for. You know, for example, the oil and gas industry has been suffering, right, with the economic downturn in the industry in the past few years. And they have really been focusing on cutting costs as much as possible and looking for cost-effective solutions to comply with the new pronouncement. With that said, you know, companies really understand the necessity of compliance with the new standard. And quite honestly, this is one of the reasons why Black Tower Advisors got formed. You know, I was at a Big Four accounting firm. The costs were way too high. Companies are looking for alternative solutions, and that's how we came about. Helping companies apply the new standard for revenue and leasing, and really working closely with them to develop a most effective cost solution to determine what is the right path forward.
Yep, that sounds about right, especially with those polling results that were just up. Actually, they kind of mirror what we saw earlier in terms of most people are sticking with spreadsheets and worksheets, and so that's probably why the cost is much lower, because it's, you know, Excel is a free tool that everyone gets. So that's a good point. And you know, one final question. In your opinion, do you think companies are then underestimating the costs associated with preparing and implementing the new standard? And that can be for any one of our panelists, but just even based on our results. What do you guys think?
I can volunteer for that question, because I can really talk from experience. And again, I would personally say it really depends, because we have seen a company that really had a very, very, very low budget for implementation, and we thought it was way low. But as soon as, you know, we started looking at their contracts and really understanding that they're really at a point in time doesn't really have any implications, you know, really long-term implication of the standard, we really understood why they budgeted what they budgeted for it, because, you know, they will have certain work to be done, but most of their work is going to be ending with the assessment phase and disclosure points and having certain processes of tracking information, but it's not going to be to the extent that some other of our clients will need to implement systems and solutions to do that, right? So I do think that while majority of companies say that they're not impacted and don't look at or some of them at least don't look at disclosure requirements to understand that the implication is not just on the recognition side, but it's also on disclosure, and a lot of companies actually have more impact on disclosures than recognition. I really believe that, yeah, to answer your question, yes, some companies do underestimate what it takes and do underestimate the true cost, but others might just not have an impact or not such great impact.
So maybe in summary, like depending on how much due diligence and understanding they really have of, you know, the entire implementation process and what they're going to do, as long as they have a plan, then they likely haven't underestimated the cost. But, you know, some companies don't know the impacts quite yet, and so maybe they have underestimated the costs.
That would be a great summary of it.
Yeah. Awesome.
And this is Shauna. I just have one more comment on that. You know, just because you don't have an impact to the amount of or timing of the revenue in your financials, and you may have some disclosure impact, it can still be a lot of work to prove that you don't have an impact. So don't underestimate that part, because you still have to have that auditable. You still have to look through the contract. You will still have new policies if some of the wording and references and such has changed. So just make sure you don't say, oh, there shouldn't be an impact, it's going to be immaterial, so therefore we don't have any work. It means you don't have any impact. It doesn't mean you don't have any work.
And actually, that Shauna brought in a really good point. A lot of E&P companies in the Houston and Southwest region of the United States effectively say they are not impacted without actually going through the process and mechanism of proving that to their auditors. Well, you know, verbally, no auditors that I know would accept a verbal statement that they're not impacted without going through the actual process of analyzing and documenting your consideration around why or why not you're impacted or not. So with that being said, you know, I would agree with Shauna that at the bare minimum, a company would need to go and undertake an assessment phase to really document and really validate those positions, because again, it happens so much that companies procrastinate and then they look at the information, and when they actually put the pen to paper, they do realize that they are impacted and they will have certain things that they will need to solve with the time. And maybe at this point it's already too late to implement a new system per se, but you know, it's probably going to be manual for most of the adopters. But as we go in next year and the years thereafter, what would be the solution to solve it? They will need to really realize that there will need to be a certain solution to solve it.
Yeah, thank you both. Those were great points. Do any of our panelists have any other final comments before we wrap it up? Okay. Well, I really appreciate you guys joining us today. Here we have some contact information for our presenters up on the screen. So thank you so much, Shauna, John, Tony, and Alex. We really appreciate your time, and it was very insightful. I hope everyone enjoyed themselves. I think Julia is going to wrap us up with some more CPE reminders and as well as some more information. But if anyone has any further questions, please don't hesitate to put a question in the box and we will get back to you.
Thank you, Kristen. And just a reminder, an evaluation survey will be sent out to all attendees on today's presentation. We will also be sending out the slides and a recorded version of today's webinar. And if you have any questions related to CPE credits or any questions in general about SOFTRAX or our webinars, please don't hesitate to reach out to us. And if you have questions or interested in automating revenue recognition software, please reach out to us via our website. We have our phone and email on the screen as well. And again, thank you everyone for joining us. We appreciate your time and hope you enjoyed the conversation. And thank you, and hope you have a great rest of your day, and hope you can join us on future webinars.
Thank you all.
Thank you.